What is up, everybody? Welcome back to another episode of Bitcoin and Markets. My name is Ansel Lindner. Today is the live CPI reaction, so we will be getting started here in just a few minutes. CPI drops at 8:30 Eastern time, so that's in 9 minutes. We're going to go through a couple articles beforehand, see what people are thinking, go over what I am thinking for CPI, then react to the CPI and see how markets react after that. So first, let's start off with the website, bitcoinandmarkets.com. This is the home base for all of my content. The only thing not on here are these live streams, and you guys are watching those on YouTube and Rumble. I also go out on Twitter and Telegram, so you can check out those places. Let's see. Price of Bitcoin. Price of Bitcoin before the CPI, 29,500. Failed this little mini breakout. No steam in the tank right now. This is very surprising to me. I thought that this was going to head almost immediately back up to the top of this range, but we'll see. We still have a couple days to go here before we get into the end of this ascending triangle pattern where a breakout should occur up here in the upper right-hand corner. But let's get into CPI. So we have a few things to look at. Time hack is 8:22. That means we have 8 minutes until the CPI. So this is from Zero Hedge. We're just going to take a look at a couple of headlines from Zero Hedge. I think Zero Hedge is the least biased. If you read CNN or something like that, I mean, CNBC can have some good non-biased reporting, but Zero Hedge has a perspective that I come from, I guess. Okay, futures rise, dollar slides ahead of dovish CPI report. And let's take a look at the dollar before we do this. So zooming out, you can see the dollar is in this channel. I thought this channel would be actually going up instead of going down because I am in a strong dollar camp. Have been correct for most of the last 2 years, but let's take a look at this. So yes, it is. It's in the upper half of this channel though, but it is slightly red on the day. Okay, let's go back to that article. U.S. equity futures and European bourses rebound from yesterday's slump and are higher into CPI, which may provide clues on the Federal Reserve's next steps, with slight outperformance from mega cap tech. As of 7:45 a.m. Eastern time, both S&P and NASDAQ futures were up 0.5%. The Stoxx 600 was up 0.4%, with travel and luxury companies among the biggest gainers on speculation that companies will benefit in an increase in Chinese tourism spending after Beijing lifted travel curbs, but that didn't occur actually, right? The dollar dropped against all majors except the yen. Bond yields are flat. Oil slipped, while metals and agricultural commodities are higher. Today's focus is on the CPI at 8:30. All right, so that's what the markets are doing pre-CPI. Let's take a look at this one. So this is Zero Hedge's like premium CPI preview. They expect core CPI month over month to be 0.2%, and it was 0.2% last year. This is kind of what I'm looking at too. It's much more likely to miss to the downside than the upside. They have core year over year at, oh wait, this is core. I'm thinking of headline, but we'll get to that down here. So core is 0.2, CPI year over year at 4.7. This is core again. That's down slightly. I think core could actually drop further than that because shelter is in the core component, where gasoline prices, which I think are going to be the other kind of main contributing factor here, are there. Food and energy is not included in core. Okay, headline month over month. This is the one everybody will see and care about, and this is coming in at 0.2%. They think that's right where I am, but it's more likely to miss to the downside. Headline year over year at 3.3%. I think that's too high. So at a 0.2, you would get 3.2, not 3.3. But anyway, so that is what they're expecting. I thought they had a couple good paragraphs down here. So, and since CPI is about to lose the benefit of generous base effects, that means months that are higher than average that are dropping off. Wall Street is increasingly shifting its focus from year over year to sequential monthlies. And that's what I've been saying for how long, guys? Monthly is what you need to look at. Year over year is slow moving BS, especially if you're talking about transitory. You're talking about major shifts in the rate of inflation or CPI, then you must look at the month over month. Speaking of Wall Street, let's start with Goldman. So Goldman, that's kind of, we don't need to get into that. Let's go to another article here. 3 minutes till CPI comes out. Markets will be blindsided by inflation comeback. And this is one thing I've been warning about over the last couple of weeks is the reacceleration narrative is probably going to get a kick in the butt this week or today, this month, because CPI is going to go up slightly. But fade that narrative, okay? Don't listen to the fudsters saying that inflation is going to be higher for longer. It's coming down. Everywhere we look, China, CPI and PPI, US PPI, European PPI, what else? Bank lending, tighter lending standards, less demand. There's less actual money printing going on right now. So the path forward for CPI is lower. But let's read the first couple lines here. So it might look like it's been defeated, but U.S. inflation is poised to begin accelerating again soon. Be fearful, people. This is just fear-mongering. Stocks and bonds are unpriced for this outcome. No. See, this is... What is this? They think they know better than the market. All right. They obviously prices are much smarter than you. Markets are much smarter than you. What you need to do is interpret the prices. You don't need to put your bias into future movements of the prices when you can't even explain why the prices are the way they are right now. So this faulty idea that inflation is going to begin accelerating soon is why they can't understand stock and bond prices, because they think they're not priced properly. Well, they are for the current situation. You just don't understand that current situation. All right, so that's it for that. Let's go over to the website. BLS.gov/CPI is where this is going to be coming out. And you see down here, we have a 0.2% for June. I am thinking we are going to get a 0.2%, but again, that is more likely to miss to the downside. If it does miss to the downside, oh boy, be ready. Be ready. Core, I think, will come down. We'll have a mixed bag here. Core will come down, but the year-over-year headline inflation will go up. So we will have a mixed bag. 829, refreshing, still June. What is up, guys? Check out bitcoinandmarkets.com, where all my content is. I'm streaming on YouTube, Rumble, Twitter, and Telegram. You guys can follow me there, like, share, subscribe, all of that stuff. Refresh again, still June. We are waiting here for the July CPI. I think it will be a miss to the downside, around 0.2% month over month, which annualized, right, is 2.4%. We will have a headline number going up slightly, core coming down most likely. Okay, July. CPI for all items rises 0.2% in July. Shelter up. Okay, let's take a look at this. This is interesting here. The CPI rose 0.2% in July on a seasonally adjusted basis. The same increases as of June, or as in June. The US BLS reported today over the last 12 months, they increased 3.2%. So that's what I was saying. The Zero Hedge was saying 3.3. My calculations, if we came in at 0.2, we would be at 3.2, and that's what it came in at, 3.2. So the year over year, excuse me, I'm coming down with something, but the year over year headline has reaccelerated. So that people will run with that. But I'll show you why you shouldn't be biting off on that too much. You should fade that narrative. The index for shelter was by far the largest contributor to the monthly all items increase, accounting for over 90%. Whoa. Okay, so last month, guys, the shelter was 70% of 0.2%. Okay. Same month over month increase, 0.2% as last month. Shelter last month was 70%. This month, it's 90%. What does that tell you? That tells you that the other components are shrinking. And shelter is taking a larger percentage of the increase. Okay, with the increase for motor vehicle insurance also contributing. The food index increased 0.2% in July after increasing 0.1% the previous month. So food slightly increased its rate of change. The index for food at home increased 0.3% over the month, while the index for food away from home rose 0.2%. The energy index rose 0.1%. That's surprising to me because, yesterday on the live stream, we took a look at gasoline, and gasoline did increase about 10%, gasoline futures. So this is 0.1% in July for energy. As the major energy component indices were mixed. Okay, so that means oil could have come down. It didn't, but oil could have come down. Gasoline went up. Natural gas went down, something like that, right? So those different components were mixed. Maybe fuel oil came down. The index for all items less food and energy, so this is core, rose 0.2% in July. That's what Zero Hedge was saying, as it did in June. Indices which increased in June include shelter, motor vehicle insurance, education, and recreation. The indices for airline fares, used cars and trucks, medical care, and communications were among those that decreased over the month. The all items index increased 3.2% for the 12 months ending July, slightly more than the 3% in June. All items less food and energy rose 4.7% in the last 12 months. The energy index decreased 12.5% for the 12 months ending in July. The food index increased 4.9% over the last year. So let's dive a little bit down in here and take a look at shelter. So here is the shelter component, and 0.4%. I mean, it has a big weighting. That's why, it's about a third. Shelter is about a third of the CPI, a third of core, maybe less of the all items, or maybe it's a third of all items. I can't remember, but it has a very high weighting, but it's coming down. So we have 0.7, 0.8, 0.6, 0.4. This looked like it was coming down, but in May, it went back up a little bit, 0.6, back down to 0.4, and at 0.4 now. So shelter is the thing that is still contributing, but it's not reaccelerating. Okay, let's take a look. I wanted to show you this. This is consumer price index for all urban consumers, shelter. Okay, average shelter. And this is month over month. I have it on month over month change. And you can see it went very high up here, up to pretty much 0.8. And then is back down here. This is last month at 0.36, rounded up to 0.4. So we'll see what it comes in July to the 100th of a percentage point. But you can see that this is coming down drastically. All right. And this is the biggest component, and it's a lagging component. It turned over way after everything else turned over, and it's coming down. Let's take a look at the all items month over month. And let's see if I refresh this. Well, I don't want to refresh it because I'll lose my formatting. But okay, so you can see the big difference here. We had COVID, then we had higher than normal CPI. So see this back here? This is post GFC normal. This is what I call it. 2016 through 2018, 19, it's, month over month, we get a 0.2, then a slightly negative, then like a 0.1, and then a whatever. So this is averaging out to under 2% CPI. Okay. Then we had COVID. Then we had a reacceleration due to what? Due to supply chains and sanctions in Europe. All right. Sanctions on Russia. So that's where this CPI came from, not from money printing. And now what have we done? We've returned to post GFC normal. Do you guys see this? Do you see this? This is post GFC normal. What is post GFC normal? Let me describe that for people that are unfamiliar with my content. Post GFC normal is the end of a credit bubble. The largest credit bubble the world has ever known, led by the United States, enabled by the United States, enabled by this, all these international institutions that the U.S. led and set up post World War II, like the WTO, the UN, the IMF, the World Bank, the World Court. All those things are set up by the U.S. after World War II and enabled the blowing of the biggest credit bubble the world has ever seen, dominated by the US dollar, and that era is coming to an end. So they're extending and pretending, but you can't add more debt to get out of a debt problem. And it's the end of a debt problem is not inflation, it is deflation. So they're putzing along here. This is the best they could do. Putzing along. Remember, 2017-18 was globally synchronized growth, people. Remember that narrative? And they couldn't get any growth. Then we had COVID, the reaction to the supply chains and sanctions, and now we're back to post-GFC normal. It's very clear when you look at this chart. We're going back into an extended pretend. We're going back into an era of asset price inflation. Now, for Bitcoin, that's very good because Bitcoin existed all through this very low inflation time. After the Great Financial Crisis, this low period of CPI and inflation, really, but CPI, and Bitcoin did very well. Bitcoin does not need inflation. Bitcoin needs the money to not be working. What happens at the end of a credit bubble? You have a dollar shortage or a money shortage because you need more money to pay off the debt. You add more debt, you just add more debt burden, that the productivity of that new added debt is zero or negative. It's an extend and pretend. It becomes harder to service the debt the more debt you add. Very simple concept. You cannot get out of a debt problem by adding more debt. And you have a monetary shortage. So what do people do? They search out new monetary mediums, new monetary assets. The reason why Bitcoin has gotten the huge bid it has over its history with this low CPI. It's not a coincidence. Bitcoin is an inflation hedge, but there's just no inflation right now. It is also a deflation hedge, a counterparty risk hedge at the end of a debt bubble. All right, so that is that. Let me go to check out the charts, the dollar. Let me go down to the 5-minute. So the dollar did react negatively to this. Interesting. Not very important though, because as I've said in the past, most initial reactions then are reversed. And look, you can see it's already reversing. It got that as low as 101.78, and it's all the way back up to 102 and rising fast. So the initial reaction is usually not the end reaction, but this is really turning around faster than I had expected. Okay, let's take a look at, well, the futures markets are delayed by 15 minutes or 10 minutes actually. So we should be getting, there we go. Look at that reaction. Look at that. This is delayed by 10 minutes. So this is the initial 8:30 reaction higher, but we'll see because it should, excuse me. Gosh, I told you I'm coming down with something here. This should be reversed. Hold on. I got a cough, so I'm going to mute myself. 1 second. And I'm back. All right, let's get back into the chart here. So that is the S&P 500 futures. Initial 8:30 reaction because it's 10 minutes delayed. This probably will reverse, but we'll see. This is interesting because if we go back to a post GFC normal, what does that mean? That means asset price inflation. And that literally is asset price inflation. It literally is inflation because as we see in the SLOOS data and the bank lending data, lending standards are rising. Well, who meets those lending standards? Yeah, the most credit-worthy people. And where do they reside? Most likely in the Fortune 500, most likely in big businesses that are on the stock exchange, the FANGs, the largest of the big companies as well. That's why the FANGs outperform so well, because they are the best credit risk. They can get the easiest and cheapest capital during asset price inflation. So where they get loans is where that is literally where money is being printed. That is the Cantillon effect. So this is asset price inflation, Cantillon effect. And so in a post GFC normal, stocks should perform fine. At least the indices, the S&P 500 should perform fine. The dollar will perform fine. Commodities will go down because demand and economic activity is going down. We also are entering a period of deglobalization. So the demand for commodities globally is going to be lower. And finally, Bitcoin is a deflation hedge and the end of a credit bubble hedge. So that is what we got. So let's take a look at Bitcoin's reaction here. Oh my gosh. Up and down. This is already retraced that initial reaction. 29,500 still. I mean, this is the most boring Bitcoin has been forever, man. I'm serious. This is the tightest the B bands has been on the weekly ever. This is the lowest ever 30-day volatility that Bitcoin has had. It's been so damn boring. But it's not going down. That's huge because every day is another day closer to the halving. Every day is another day closer to an ETF being approved. It's not if, it's when. So overall, it's very bullish, but it's been super, super boring here. Okay, at least for price. That's what I'm talking about. All right, let's take a look. That's it. That's where I'm going to leave it today, guys. I'm going back to the website. Check out bitcoinandmarkets.com for all of my content. I write some blog posts that go out to paid members first, then I put them public. You can see I have a crypto affinity fraud piece. Then I released, where's the other one I released recently? Oh boy, Coming Multipolar World. I probably messed up on the tags on that one. But those are the blog posts. They go out first to paid members, then they go out to the public a few days after that. So if you want to support my content, support this unique perspective in Bitcoin and macro, I would appreciate, I would love for you guys to check out bitcoinmarkets.com. At least sign up for the free weekly newsletter. And if you would like to support my content, you can do it there as well monetarily. Appreciate everybody that does support. All right, guys, that's going to do it for me. I'm out. I will be 12:30 Eastern on FedWatch with Bitcoin Magazine. Check that out. I will be tweeting about that beforehand. But anyway, okay, so CPI 0.2% month over month, 3.2% year over year. As expected. Ciao.